Good evening. This side Rahul Magan here is a Group Chief Executive Officer, Treasury Consulting. As we speak, Treasury Consulting is a multi-asset and multinational hedge fund. By multi-asset, I mean we actively covering our positions in multiple asset classes like gold, silver, platinum, base metal, agriculture commodities, equities, foreign exchange, and respective. From multinational, I mean we actively covering our positions in multiple asset classes, multiple locations. Like I repeated many a times, and I would continue to repeat all the times that we are a proprietary hedge fund. By proprietary, I mean no third party. Let me repeat, no third party can invest capital in our fund. Please do take a note of that. You know that I worked as a corporate treasurer for American companies, and one of the currency which I handled in the last as a corporate career of around 9.5 years is USD INR. And after that, I predominantly focused on G7 currencies, uh, my my trading desk of currency, which is not open to public. Guys, I'm raising this point from the last many years on public platform that India is running NIIP. By NIIP, I means negative international investment position. Unfortunately speaking, many people across the globe barely have any idea about net international investment position. Actually, net international investment position is nothing but a difference between FX assets, foreign exchange assets, and foreign exchange liabilities. So, plain language, you are earning 100 rupees, you know. So, common sense, your savings won't be 100 rupees, your savings would be 10 or 20, probably 30, at max 40. Why? There must be an expenditure of 60, which might be your kids, tuition fees, home EMI, the car petrol, or the miscellaneous expenses. So the net saving you are max to max 40. Okay, this is the net saving you are having. Now, having said that, can I say that if you are earning 100 rupees, your saving is also 100 rupees? No. This is absolutely technically, mechanically incorrect statement. Similarly, our beloved media always give one figure in the public, and that figure is nothing but the FX reserves of Reserve Bank of India. And if for a relevant month that figure turns out to be an upgraded figure, then our beloved media hype this figure. Okay, but the same beloved media do not share that there is a concept called FX liabilities also. There is no country in the world except one, which is United States, and the tactful reason is USD is the home currency of US. And USD, as we speak, is the reserve currency holding near about 55% of the global FX reserves. Henceforth, the composition of NIIP is nowhere relevant for US, but apart from US, it is relevant for all countries of the globe. Please do take a note of that. Current governor, previous to that, Mr. Urjit Patel, previous to that, Raghuram Rajan, previous to that, I think Reddy sir, and previous to that, Subaraji. Everyone went through negative international investment position. But unfortunately speaking, there is hardly any steps taken by Reserve Bank of India to stop negative international investment position. This is the pillar why Indian rupee, as we speak, is around 82. I remember I started my treasury career somewhere June 2007. Everything went well in the first 6 months, nothing wrong, thanks to God. Around September 2008, Indian rupee touched 50, and I was barely 1 year old in the treasury career. Barely 1 year old. It was a huge panic at this point of time that Indian rupee touched 50, because I still remember at that point of time, without quoting any specific name, many corporates in India sold the currency options and forward contracts at 35, 36, and 40. They end up losing several hundred crores in their hedging part, and we know that in 2008 period many Indian corporates reported huge losses thanks to FX asset management. And then I told people, because I was not having any YouTube channel, I told to my inner circle that please be rest assured, Indian rupee would be 50 forever. Slowly and steadily, Indian rupee touched 55, then 60, then 65, then 70, then 75, then 80. As we speak, it is approximately 82. And I'm telling you one thing, that history is witness. The level Indian rupee crossed, Indian rupee remain on that level. So in 2008, 50 used to be a benchmark level for Indian rupee. Today, the benchmark level for Indian rupee is 82 to 83. And do you know one of the reasons why Indian rupee is depreciating too high? Our beloved media and few paid economists link this with the US dollar. They're saying that if there is a strength in the US dollar, it means the Indian rupee would depreciate. But these Einstein, Edisons, and Newtons do not aware that the two strong reasons behind that. Number one, India hold negative net international investment position, which is NIIP. That is more than $200 billion on an average basis. And you know the sad part of it, the sad part is Reserve Bank do not maintain a real time data of the same. I've been through RBI website many times, try to scrutinize the real time figure of the NIIP, but every time I end up with a sad face because I never been able to get the real data. And unfortunately speaking, except RBI, no one able to provide the real data. That is another big problem. So this is the first reason why India would continue to maintain a depreciation of Indian rupee. So today it is 82 to 83. I might not be surprised that that would turning out to be 90, and there is a tactful reason behind that. Second reason why Indian rupee is depreciating and would continue is the negative trade deficit. In technical parlance, negative trade deficit means that your imports are much higher than your exports. And one of the ratio which generally is considered as a valuable ratio is that if suppose across the globe the total export is of $100 for a minute, assume, then how much composition you are holding of that $100? $5, which means 5%, $10 means 10%, $15 means 15%. This work I leave to you. You please do your research and let me know that out of the total exports of the globe, how much percentage India do have. Please check yourself. Please check yourself. Today I got some statistics in the public domain. And this statistics is really a scary statistics. This is a scary statistics because I not be able to digest these statistics, but unfortunately, numerical numbers cannot be challenged. That's another beauty of numerical numbers. In the last 9 months, which means April 2022 to December 2022, because this 3 months data is pending, which is January, February, and March. I think we would be getting this somewhere in May. In the last 9 months, which is April to December 2022, India maintained negative trade deficit as far as the export and imports are concerned. Now, in April, this is 20.1 billion. Please do note that the value which I am quoting is in dollars. Please do note that it is in dollars. It is 20.1 billion. In May, it is 23.3 billion. In June, it is 26.2 billion, all negative. In July, this is negative 30 billion. In August, this is negative 28 billion. In September, this is negative 25.7 billion. In October, this is negative 26.9 billion. In November, this is negative 23.4 billion. And December, the last month of data, is around negative 23.7 billion. The interesting fact is the person who made this chart, he don't got time to the total to make the total. That also I did. Total is 227.3 billion. Interesting. 227.3 billion is the total trade deficit of India in the last 9 months. I did the average, and that average is around 25.25 billion of the last 9 months. Let's use some common sense. In January, February, March, suppose this average maintains. Common sense. In this eventuality, the total trade deficit for the year, financial year 23, you can say, that total trade deficit would end up being 300 billion approximately. It would end up being $300 billion. I am from treasury background. I understand hedging, maybe making videos on that. To hedge this, RBI needs to buy dollars. Common sense. Because if your trade deficit is negative, your payments are in dollars, you're supposed to pay dollars outside. For that, you need to borrow dollars from the market. How long you be dependent on invisibles? Invisibles is nothing but the remittance of software companies in India. So all the software companies, whether they are Indian software companies or American software companies or European companies or any other IT company works in India, they they do the invoicing to their customer, and then customer pay back to for the services they attained. And the money which flows in India, this money is called, invisibles in our current account. Unfortunately, people add FDI also in this, which is foreign direct investment. Guys, FDI is of two types. Number one, it is the I would say the green field. Number two is the brown field. So all those intelligent people who are adding FDI, please note that you need to first categorize whether it is green field and brown field, right? So 100% component we cannot take on. So please do take a note of that. But guys, if India would continue to maintain the NIIP, which is negative international investment position, in such a huge number on a negative side, read with government continues to maintain the trade deficit 227 billion, in the last 9 months, and common sense, it would end up being 300 billion. Common sense for financial year 23, it would be a big number. Considering this as a backdrop, and technically speaking, I don't expect rupee to average out to 75 soon, because the both pillars who can make rupee lower, whether this is NIIP or whether this is trade deficit, they are not supporting technically. This is what I would like to say. Common sense, I am tracking these statistics on a very often basis in the public, but unfortunately, time is very limited. Since time is limited, you won't get time to make videos on all the topics. This video I'm making around 17th January 2023 in the early morning hours, and I'm sure it would be live not before February 2023. The kind of things you are into, so much to do. But nonetheless, thank you very much. Our beloved governor of RBI, who wanted to ban cryptocurrency, but he never get time to explain this and the impact of this on NIIP. I'm sure about this. This is Rahul Magan from Treasury Consulting Group. You knew my personal number, +91 98 99 242 978. Let me speak, +91 98 99 242 978. Alternatively speaking, in case you wish to have more information, you can visit our fixed income platform www.fixedincome.global. www.fixedincome.global. Thank you very much. Have a great time ahead.